If you're a first-time buyer and you have not been approved for your mortgage yet, but you still want to see what your options are, well, that's kind of working backwards. However, in this video, I'll show you a quick way that you can kind of pre-approve yourself, see what you would qualify for, so that when you do go on realtor.ca or on House Sigma or whatever website you're using, you kind of know what your parameters are. Because one of the worst things a buyer can do is shop beyond their budget. So stick around. If you want to get into the market, you haven't been pre-approved, you're very early in your search, don't worry, I got you. Let's see what you would get approved for. I'm Athar Jaffrey. I've been selling real estate in Mississauga, in Toronto, and the GTA for more than 20 years, and my goal is always just to make the buying and selling process simple. Okay, so let's get right into it. I'm not going to waste any of your time. The easiest way for you to see what you would qualify for is like this. So take your gross income, annual income before taxes. Now, if it's you and a spouse or a partner or a family member or a friend, then take both incomes and combine them. Gross before taxes. And then what you're going to do is basically just multiply it by 4.75. This is a rule of thumb used by lenders. It's not exact, but it will give you a very good estimate and pretty accurate of what you would be approved for a loan amount. Now, there are other factors that can lower this, and we'll get through that in a second, but this is the overarching calculation to figure it out. So take your income, multiply it by 4.7 times, and then add your down payment. So for example, if you make 100K, you multiply that by 4.75, it equals 475,000. That's the loan amount. And then on top of that, you're gonna add your down payment. Let's say you have only $25,000. Then your total purchase price is roughly around $500,000. So when you do this calculation, let's say you haven't spoken to a realtor, you haven't gone to the bank, but you wanna start searching online, I highly suggest you do this calculation first before you start looking at anything online, because you don't wanna look at things that you can't afford. It just sets you up for heartbreak. The next thing I kind of want to explain are GDS and TDS. And this also goes into account when the bank is approving you. And this is how your mortgage approval amount may not actually be 4.7 times your income. It may actually end up being a little bit lower, but I will just want to quickly explain why. So the first one is GDS, gross debt service ratio. And this tells you how much of your income should go towards your housing costs, just housing costs. And it includes obviously stuff like your mortgage payment, your property tax, your heating costs, and they only take 50% of the condo fees into that calculation. So basically, for GDS, they take a number of 32% of your gross income before taxes. So 32% of your gross income before taxes should go to these things that I've listed here: mortgage, property tax, heating costs, and 50% of condo fees if there are any. So for example, if you're making $100,000 per year, your max housing cost should be about $26.67 per month. That is based on the GDS ratio. But life is hard, and we all have, maybe some debts on the side, like a car loan, student debt, credit card debt, line of credit, whatever it may be. So the calculation that the bank uses for that is called TDS, total debt service ratio. And for this, they'll take your housing cost, which is the GDS ratio, plus any other debts that you might have, your monthly cost on that, and they'll put all that together, and then they'll say, okay, based on this, your total debt payment should be no more than 40 to 44% of your gross household income. So then they'll take all the debts, they'll take your GDS calculation for your housing costs, like mortgage and all that, put it together and say, okay, 40 to 44% of your gross household income has to go towards these expenses. That's how you'd get approved. So for example, if you make $100,000 per year, your total debt payments should be about $3,333 or $3,367, up to $3,667. That is with all your other debts combined. So back to the first calculation, if you take that 4.75%, that is hypothetical if you have no debts. Once you have debts, it's going to start to kind of bring that approval amount down. So maybe it's not 4.75 times, maybe it gets down to 4.5 times. But you could refer back to your TDS ratios to see roughly how much is that going to lower your purchase price. So the next thing is obviously you need good credit, guys. This is a pretty no-brainer aspect of getting a mortgage. However, there are ways to get mortgages if you don't have the best credit. But what is exactly considered good credit? The bank says about 680 and up. Now, you might be making all your payments on time, but your credit score might not be that high. And that could be because your debt load is too high. Maybe all your cards are maxed, your line of credit is maxed. So even if you're making your monthly payments, they look at the ratio and that could lower your credit. But if you are looking to get a mortgage and you just want to know roughly what kind of credit do I need, minimum it's about 680. However, there are some lenders now that will get even lower. A lenders, they might even let you get by with around 650. So it really just depends, but ideally 680 and up. So very quickly, how to pre-qualify yourself for a mortgage. What are the minimum down payments required? So for a home up to 500,000, the minimum down payment is only 5%. For homes up to 500 to 1.5 million, it is 5% on the first 500K, and then anything above and beyond 500,000 is 10%. For homes over $1.5 million, it's 20% down payment. This is pretty basic stuff, but some people, they don't know this, especially people that are just brand new to the market, never owned before, and now they really want to learn everything and they want to know what's the minimum down payment that I can add on a property that I want to buy if I multiply my income by 4.75 times. They'll be able to figure it out this way. Of course, if you put less than 20% down, you will need CMHC mortgage insurance. We'll talk about that another day, but basically that is an insurance that the lender will tack onto your principal amount, and it's their insurance. If you miss a payment, they're covered. It really doesn't cover you for anything. Obviously, the more down payment you make, the lower monthly payments it'll be, and better chances you have to get a mortgage approval, and less income you might need for the same property that you might be searching for if you have a larger down payment. So what are the monthly costs with the minimum down payment? All right, so if you're getting a $500,000 condo, your mortgage with 4.2% interest is about $2,400 per month. And now if you look at this number, it's very close to the GDS ratio that we talked about. So if we very quickly go back to the GDS ratio, what it said for 100K, your housing cost should be around $2,667. Now if we go back to this here, it's saying about $2,400 a month, half your maintenance fee, property tax. It would bring you about to $2,800. So it is close to the GDS ratio. Your minimum down payment is $25,000. Your income required, around $100,000. Okay, now you want something a little bit bigger. Your income is larger or higher than 100K. Let's take the next step up. At $800,000 townhouse or semi-detached, your mortgage would be about $3,780 with the 4.2% interest. These are fixed rates. I mean, it's give or take. It's an approximate. And your minimum down payment required is $55,000. On $800,000, your minimum down payment is $55,000, and the income required is roughly around $155,000. Now you want to take it up a notch and you're ready for that detached home, but it's still your first home. You haven't owned anything before, but you got a great job. So let's see, $1 million semi or detached home, your mortgage would be about $4,693 with the minimum down payment. And the minimum down payment here is about $75,000. And the income required is $195,000. This is just a little breakdown so you can see where you land. Again, if you've never done a mortgage pre-approval, you haven't even taken any first steps to own a home, but you know you want to own a home and you're ready to do it, this is a great place to start. This kind of gives you kind of rule of thumbs of where you stand in terms of your down payment and your income. Common mistakes that you got to avoid when you're getting a mortgage, because nobody wants to be house poor. So the first thing is, don't max out your budget. Whatever the bank tells you, I would probably buy below that max budget, because you have a lifestyle that might include a lot of Uber Eats, unfortunately, which is probably the worst financial decision you can make. You love your shoes, you're a shoe collector, or you love entertainment and going out with your friends to bars and parties and stuff. So all that is going to reduce your affordability. The bank doesn't know all this, but you know all this. So the bank is assuming you have no other major expenses, but partying can be a major expense, or shoe shopping, because I have friends, they collect a lot of expensive sneakers. That can become an expensive habit. So when you are ready to finally get into the market and you do get your official pre-approval from the bank, I would not buy at the top end of that. You got to keep it lower than that. You don't want to be house poor, and you don't want to have to give up things that you love or enjoy doing. So just because the bank says you're approved for a certain amount, it doesn't mean that you can afford it. Keep that one in mind. So that's it. I hope this helps. This was a very simple way for you to kind of figure out what you get approved for. You kind of got to see what mortgage payments are like in different price points and what kind of income you need. If you have any questions, there is a contact form below. Fill it out and someone from my team or myself will get back to you. Or you can just call me directly, 647-208-9724. Again, my goal is just to make the home buying and selling process simple. So I hope this helped. And if you know somebody that is looking to buy or sell and they're in the preliminary early stages, then this is a very good video for you to forward over to them. And hopefully it helps them understand what they're approved for before they actually start searching online. I'm Athar Jaffrey. I've been selling real estate in Mississauga, in the GTA and Toronto for more than 20 years. And again, my goal is just to make the process simple.